Hey guys, Domenic Neshi here from Wealthy. On this episode, we have the infamous Daniel Berti.
Pleasure to be here, guys.
So Daniel is not a mortgage broker. Not a mortgage broker.
No.
You iterated that on the first time we caught up. He's a financial strategist. And look, I say this because it's critically important for people to understand that there are differences. Out in the market, you will work with many, many people that can go and write you a loan, but that's very different to someone that can actually strategize, work with you, and structurally come up with the right financial instruments, tools, banking institutions that serve your interests and needs. The way that many mortgage brokers will try and get into your pocket, into your household, is by saying, we're going to get you the best rate. Going and getting the best rate is really not much of a skill set. You know, you jump on Connective, you jump on, any other platform.
You can go online. You can. It's as simple as a Google search, and you can find the best rate. So a strategist, right? The benefit of a strategist opposed to a mortgage broker. Well, a mortgage broker, you go to a broker and say, look, I want to get the best interest rate. I want to refinance. While I'm at it, I'm going to top up my mortgage to buy a car, for example, right? Whereas a strategist, what they'll do is they'll provide more of an education piece, and they'll work closely with your accountant. And what they'll do, for example, is they'll say, look, rather than using, your equity, which is gold, right, to purchase a car, what we'll do is, we'll use it to purchase an appreciating asset rather than a depreciating asset. So it makes people aware, right? A strategist makes people aware of the benefits of using equity rather than, purchasing something that's depreciates in value. So a mortgage broker, the benefit of a mortgage broker is simple as this: they'll get you a good rate, they'll package your loan, and they'll find you a great solution, and so be it.
So what you've just said there is that a mortgage broker will find you a product that's out in the market.
Yes.
They'll pull something off the shelf. They'll help you just go and get something from the bank.
Well, a mortgage broker, the whole purpose of a mortgage broker really is to basically find a solution based on your scenario and identify what's important to you in a loan, and they'll structure your loan to, I suppose, benefit you, right? So they'll ask questions such as, do you need an offset account, do you need a redraw facility, all that kind of stuff. So, a mortgage broker, it's very basic in terms of
entry level sort of.
Yeah. Whereas a strategist will actually educate you on how you can build wealth and build a sustainable lifestyle at retirement, rather than just an interest rate. Does that make sense?
It makes a lot of sense. And the reason why is because I've worked with you, I've heard you talk about the way that you structure funding, and I've worked with financial strategists like yourself in the past. To a lot of you out there that are listening, watching, some of you have got properties, you've got your own home, and you're thinking about going and buying a property investment, and there are many, many ways that you can structure your debt to go and buy this property, right? When you are working with someone that has their own home and they're looking to go and buy a property, there are different ways that you may suggest structuring their debt.
Of course, yeah.
Okay. Can you sort of shed some light on one way that may make sense?
Well, to purchase their first home?
To purchase their first investment.
Oh, sorry,
they own their own home, they've got some equity, they're thinking about buying an investment.
Right. Okay, so the way that I would look at it is, I'd say, okay, well, the traditional way and the way that most banks will actually structure the loan is they'll say, okay, we've got equity in your current owner-occupied property, we're going to use the equity, cross-collateralize, and purchase and borrow 100% against the investment plus costs.
Cross-collateralize? What does that mean?
So cross-collateralize, what that means is they're going to use your property as security to purchase the other. So for example, if your property is worth $1 million, right, and you have equity of $500,000, then what they'll do is they'll say, okay, you're purchasing another property of $1 million, total value is $2 million, okay? And the loan amount is 1.5.
Yep.
Okay. So they're using both properties as security against the both of the loans. the owner-occupied and the investment.
Total asset, total debt.
Correct. So it's tied in together.
Yeah.
Okay. So the way that a good finance strategist would structure it is they'll say, okay, rather than using the owner-occupied as security and cross-collateralizing, is they'll say, okay, what's the purchase price of the investment property? It's $1 million. So 20% of $1 million is 200,000. What they'll do is they'll say, all right, you've got 500,000 owing on your owner-occupied. Let's top up your owner-occupied mortgage by 200,000 plus costs such as stamp duty, solicitor fees, government fees, and we'll use that as a cash deposit towards the investment purchase. What that does is that means that you won't be cross-collateralizing your property. So you'll have your 500,000 plus another split of 200,000 plus costs. So let's just say 260, and then you'll have a new loan of 800,000 and $1 million property. So they're both separate, but you've actually obtained the 20% from the bank in cash to contribute towards the next purchase.
So let me unpack that the way I'm understanding it. So you've got your own home, you've got $500,000 in equity.
Yep.
What you're doing is pulling out 260,000, so 20% plus costs,
Yep.
as available cash.
Mm-hmm.
So now the loan amount on your own home is going up.
Will increase, yes.
Will increase by the 260K.
But remember, the 500,000, and this is me just going off a purchase price of $1 million,
Yeah,
right?
yeah.
So to say that you've got enough equity.
Yeah.
So the loan amount of 500,000 that you have at the moment isn't tax deductible, right? So you have that on its own, and we create a new split of 200,000 plus
Yep.
costs. That loan becomes tax deductible.
Yep.
Okay. Then the 80% lend against the new investment purchase is also tax deductible. So essentially, you're borrowing 100% plus costs, and both loans are tax deductible, right?
So what you've done is you've siloed the two different debts. You're keeping your own home debt as low as possible. Mm-hmm. You're pulling out some cash, creating a new debt facility,
Yep.
and then buying a new property, which will then be its own set of gearing.
Correct.
But that's effectively 100% geared plus costs.
Correct.
And all of that debt now is fully tax deductible.
That's right. And then what we'll also do is we'll organise an offset account against your non-tax deductible debt, which is your owner-occupied mortgage of 500, and the rent that you receive from the investment property will be deposited into your offset account that's linked to your owner-occupied mortgage, which then reduces the interest that's charged on the owner-occupied mortgage.
So you're trying to create a facility for the homeowner to constantly pay down or lower the principal component of their own home.
Correct. Yeah.
So we're getting pretty technical here, and Daniel's being very courteous. He's sharing a lot of information. He's making it seem like it's easy.
Yeah.
It isn't.
There's more to it. There's actually more to it in terms of the structure. We go as far as making some of the owner-occupied debt interest only and all that kind of stuff. But it all depends on the goal of, the strategy of each person's, every person has a different strategy. So it's always tailored, all right? So there is more to it, but this is sort of the basics.
Yeah, we're using it as an anecdote, an example of how there are differences between going and getting a rate versus going creating a structure and creating a strategy for hitting your goals. So a lot of the things that Daniel just described there may not come with the best rate. The reason being is because we've got to create two different loan facilities. You've got to create an offset account, and every time you cut up this loan and try and do something different, there may be a fee. There may be a new rate that's associated to it because of the different levels of risk. There are different ways to structure your debt that may cost a little bit more, but it gives you a bit more flexibility. It gives you another way for you to go and attack your financial dreams. Am I correct in saying
100%,
that?
100%.
Yeah. So that's the big difference between a mortgage broker and a financial strategist, really.
Yeah. Well, mortgage broker would just offer you the best rate, best structure. They'll do the right thing by you, where they should be, and they'll offer a great solution. But if you want more than that, a strategist is the way to go. They'll educate you on why you should be purchasing properties to build wealth, and or why you shouldn't be purchasing depreciating assets using equity, things like that. A normal mortgage broker would just say, yeah, no worries, mate, I'll do your mortgage, I'll get you the best rate, we'll top up the mortgage and give you the car, no problem. But really what we should be doing, and what most brokers should be doing, is educating the client to say, look, you've got great equity here, you've built that, it's time to put good use to it and actually build portfolio and wealth for the future. Yeah.
So does that mean that in your role you're saying no to people as well?
Well, it's not that I'm saying no. At the end of the day, I will offer that service and I will, mention it to them. So I provide the education, right? If they say to me, look, Daniel, no, mate, I just want a better rate, I just want to refinance, then so be it. I'll never say no, but I'll always offer the education so that way they're aware, right? Because a lot of people aren't aware of how they can use equity and how they should structure their loans to purchase property. A lot of people think they need to come up with cash, which is very common. I wouldn't say no.
Okay. Well, thanks for being so open and candid and talking about the different financial strategies. Whilst we're talking about some strategies, I want to chat about first home buyers or first-time investors that may be using first home buyers grants. Now, a common question that we often receive from our clients is, how much do I need to get started? And I'll say, it can be 20%, it can be 10%, it can be 5%, it can be 0%. And it does come down to your circumstances, your family. There's a number of different ways that you can enter the market, especially with government grants. I won't go too deep in that right now.
Yeah.
But can you have a chat about, can you give us a little bit of an idea around, the minimum? What's the entry, the lowest entry amount?
Well, look, if you don't own a property or if you don't have equity in a property, I would say you would need at least 10 to 12%, right, deposit. And the reason being is because look, there are lenders that will offer 95% lend on investment, but the rate isn't as great. Okay, you're going to be paying quite a high premium. Also, in addition to that, you'll be paying a high lender's mortgage insurance charge, right, which is short for LMI for short. So, in order to get a good rate, I would say you would want at least 10 to 12%, but also, look, you want to have 10 to 12%, and the reason being is because 10% will go towards the purchase. All right, 12% will cover your lender's mortgage insurance. Lenders at the moment, most lenders will only lend up to 90% inclusive of lender's mortgage insurance. So what that means is they'll go 88% lend plus lender's mortgage insurance, bringing it to 90. So give or take 12% or 13, yeah. Okay,
and if someone's a bit more fortunate and they've got family with property with, a little bit of financial security and they haven't got much of a deposit, will banks lend to them, and what does that look like?
Definitely. So we've got lenders on our panel that will lend up to 100% plus costs if you've got a guarantor. So if you've got mum or dad, they've got a bit of equity and they're happy to help you out, you're able to borrow 100%. So basically what will happen is 20% will be secured against their property, and then 80% will be secured against your property. So, and you can borrow costs as well, so 20% plus costs against theirs and 80% against yours.
What's the risk there?
The risk, well, there's no real risk for you as the consumer, as the purchaser. The risk to the guarantor, well, look, the only risk that the guarantor would have is if you didn't pay your mortgage, and the bank took legal action and had to repossess the property, the house.
So basically, you can get your mum and dad to be guarantor on your loan.
Yeah.
They're going to put up one of their properties to go to protect their interests. Yeah. The bank's going to protect their interests. So if you don't pay your bills, you don't pay your mortgage, and they'll come after your mum and dad for their home.
Basically, look, we do limited guarantees. So again, we only secure 20% of your purchase against your parents' property. So we will never secure 100%. When you secure 100%, there's more risk to the guarantor. And, again, that's the difference from a strategist or going to a bank directly. A bank directly, chances are they'll write 100%. secured by the parents' property. If you speak to a good mortgage broker strategist, they will secure only 20% limited guarantee against your parents' property.
And then how do we remove the guarantee later? What's the process?
Well, look, if you pay interest only, you're not paying down the balance, okay? Now, the benefit of interest only is that, the interest component is tax deductible. If you're paying principal and interest on the mortgage, the principal portion isn't tax deductible. So what we find is a lot of investors don't pay P&I, which is principal and interest. So when you're purchasing an investment property using a guarantor as interest only, you're really relying on the property to gain value, right? So you build equity in the property. Now, based on the current market in the last, not the current market, based on the last 10 years, right, property prices have been increasing. So removing a guarantor has been quite quick. You've been able to do it within 5 years.
So you need the property to basically get up to that sort of 20%, 80% threshold before you can remove it.
Correct. So you want to build at least 80%, you want to build at least 20% equity. So the amount that they're guaranteeing, you want to build that amount so that way you can refinance at 80%. So that way you steer away from lenders' mortgage insurance as well. So I'll quickly just touch on that. So you only charge lenders' mortgage insurance if you borrow more than 80% of the property value. Some lenders allow you to go up to 85, and there are even some lenders at the moment that allow you to go up to 90. Now, you want to steer away from lenders' mortgage insurance because it's dead money. And lenders' mortgage insurance, what it does is it insures the bank in the event that you default on your mortgage and that you need to repossess the house. If they repossess the house and sell your property at a loss, then they're covered by Genworth or QBE, the lender's mortgage insurer. So we all know that chances are you're going to maintain your monthly repayments, you're going to stick to them. So when you're being charged lender's mortgage insurance, which is added to your loan, not only do you have to pay that off, you also charge interest on that. So it's dead money. So if you can steer away from lender's mortgage insurance, highly recommend it.
But it is all tax deductible, right?
Look, if it is an investment, yes, it is tax deductible because it's part of your mortgage, right, and your loan. So the interest component is tax deductible.
Okay.
Cool.
Awesome. So for first home buyers, don't have a deposit. Mum and dad can help you. The ones that are saving and trying to gear into a deposit, 10 to 12% is what Daniel's saying is what you need to get in.
Yep. Also,
tell me
real quick for first home buyers.
Yeah.
All right. There's first home loan deposit scheme that the government has brought out.
What does that mean?
So first home loan deposit scheme, you only need a 5% deposit and the government will go as guarantor just like mum and dad. And the only downside is that you can't purchase an investment property and you can't buy it as a first home owner occupied and rent it out whilst the government is a guarantor. So if you don't have a great deposit and you apply for the first home loan deposit scheme, you only need a 5% deposit and it needs to be classified as genuine savings, so you need to have it in your account for at least 3 months. So not only do you have the first home loan deposit scheme from the government, right, going as guarantor, you have your parents to go as guarantor, and if you have another property, you can use that as equity. But if you're a first home buyer, it doesn't matter.
Okay, so with the government guarantor facility is the same as mum and dad. Once you get up to 80% LVR, you can remove them as a guarantor, and then you can move out of that property, turn into an investment.
Correct.
Cool.
Correct.
Cool. Okay, we've spoken a lot about strategies, way that you can enter the market, differences between a mortgage broker and a strategist, and trying to get the lowest interest rate isn't the most important. Can we have a little bit of a chat about what's actually happening in the market, things that you're seeing that are changing? One of the topics I'm really interested in is the changes in responsible lending and what that might mean.
Yeah. Okay, so responsible lending. That was brought out in 2007 by the Rudd government, and it happened after the GFC. And what it does is it holds the banks accountable and ensures that they are responsible in their lending. Now, when that was brought out, what we found is that banks started tightening up their policies, which made it harder for borrowers to actually access credit. So basically because of COVID, what the Treasurer has done is he's scrapped 100 pages of NCCP, which is responsible lending. And what that's going to do is it's going to free up the flow of credit. And the way that that's going to happen is the banks now aren't going to be held responsible for, people, not paying their mortgage. Because what was happening is the bank would scrutinize applications and say, okay, we want to see your living expenses. We can see that you're, eating Uber Eats 3 times a week, right? And they'll go, your living expenses are quite high, your borrowing capacity is now less, okay? Now, if they didn't do that correctly and they didn't scrutinize the living expenses, for example, or, their income correctly and et cetera, and make sure that they can actually afford the loan, the bank was held responsible, right? So really you could just take the bank to court and probably win the case, right?
So what you just said there is if the bank was responsible to you and how much debt you can go and get.
Basically,
so you could go and apply, and then if you defaulted, the bank was like deemed irresponsible for giving you the money.
Well, yeah, you could look if you had a good case, right, to say, oh, look, no, you didn't look at my expenses correctly. Really, you could win the case, and But look, at the end of the day, we're all adults, right? So if you can afford a loan or not. Well,
Hopefully.
Well,
we're the strategist.
It's not but it's not that you don't know if you can, that you can afford a loan or not. It's more so like if you have the responsibility of a mortgage, right? Well, then cut down on Uber Eats. Stop getting on the piss. You know what I mean? And just know that, all right, I'm an adult. I've got responsibilities. I've got to maintain my mortgage repayments. So
it's an interesting topic. Sorry to interrupt you there, because people actually change their behaviors to match their circumstance.
Correct.
And that's what the responsible lending doesn't really factor.
Exactly. So right now, basically what the Treasury is saying is they're saying, look, rather than banks being held responsible, we're now moving to a borrower being responsible type of model. But in saying this, look, banks are still going to be held accountable to, make sure that their policies and procedures are,
rigorous, and they've got to check the statements.
They're not just going to go and give you, a 10 million bucks, and not look into your financial position. But what they're going to do is they'll probably, they won't ask for a breakdown of living expenses, for example. This is just my opinion. I don't know.
The granularity,
Yeah, nothing's been changed yet. But I reckon, what we'll find is that rather than going, okay, what's your transport expense? What's your grocery expense? What's your insurance expense? They'll say, okay, break it down to us. Let us know real quick what your total monthly living expenses are. If that's what you declare that they are, then so be it, right?
Yeah.
So what we'll find, right, after responsible lending, once these changes are made, what we'll probably find is that borrowing capacity will probably increase, I reckon, by about 50,000 on average, 50 to 100,000, depending on the applicant. So every scenario, every person's position is different.
That's pretty cool. So with responsible lending laws potentially being thrown out or being changed in March, we're looking at buyers having more potential buying capacity.
Definitely.
So it's just another stimulus to demand, really pushing the property market.
Definitely.
And are you seeing any other new products or any other sort of stimulus in that lending landscape, because all the banks are sort of pushing one agenda or another? Is there anything, any new facilities? Is there any new ways that clients can go and lend money? Or
yeah, look, I mean, interest rates, if we're talking about interest rates real quick, I mean, there's interest rates as low as 1.89 fixed for owner-occupied.
Wow.
Investment, I got a client 2.29. Interest only for 3 years fixed.
2.29 interest only 3 years.
Yeah, look, there's a lot of terms and conditions. So let me just put a quick disclaimer out there, right?
Yeah.
Everything that we're talking is general, and everyone's position is different, okay? And also, there's a lot of conditions, and if you want to know more, you can always contact us, right?
Yeah.
But
Daniel specifically.
Yes.
Not me.
Daniel at Berti Financial.
Yeah.
So yeah, look, we've been able to get some really good interest rates at the moment. Fixed rates are lower than variable, so that does show us what the banks are sort of thinking. Variable at the moment for owner occupied, you're looking around 2.5. Investment, there's always about 0.3 of a difference, and when I say of a difference, it's always 0.3 higher than owner occupied rates for investment.
That's very low.
Yeah, you can get investment. Well, this is P&I. Interest only, you'll be looking at a little bit more of a premium as well.
So we're certainly talking all sub threes.
Yeah, you can get sub threes for sure for investment, definitely.
Okay, so if you're out there, you've got some kind of loan against any of your properties. If you haven't already, I'd be freaking surprised. But go and check how much you're paying at the banks. Go and chat to a mortgage broker, or even do something as simple as just talk to your bank. I think clients don't actually understand this. Like, if you can't be bothered by doing all the mortgage applications and whatever else, you can just call your bank and say, hey, I'm paying too much. Can you review it if you're on a variable interest rate?
Well, look, what I would recommend is actually if you do have a broker, or even if you don't have a broker, speak to a broker and or your broker and say, look, I've noticed that my interest rate seems a little bit high. Your broker will be more than happy to contact the bank on your behalf while you sit at home watching TV, reading a book, having a tea, right? They'll contact your bank on your behalf and negotiate the rate for you free of charge. And if they can't, if the bank isn't willing to come to the table, then the broker will say, okay, well, a good broker will say, yeah, okay, look, there's other options available on the market.
Yep.
Let's look at refinancing because your current bank isn't offering anything, And I thought I would quickly mention, since you asked about any new products or any kind of promos or whatever, at the moment, banks are actually paying cashback rebates to win your business. So if you don't have a great rate at the moment, and you're interested in refinancing to another lender, you've got St. George, for example, offering $4,000 cash back to win your business. And the great thing for investors is that St. George will actually pay $4,000 for your first property. And if you have, say 2 investment properties, they'll also pay another $2,000 each. So a total of $8,000 to win your business per property.
So the banks are fighting that for your business, they're going to give you some cash back. So it's
Yes.
well worth your time and effort to have a look at what is available out there to you.
Definitely.
Daniel, mate, thanks for coming on the show, having a big chat. I would like to hear more from you because today we only really spoke about one quick strategy. It'd be good in the future to talk about some more specific stuff. Any of you that are out there that want to talk to Daniel, reach out to us, Daniel, directly. I hope you got some value out of this show. If you've got any questions, leave them in the comments. Send us a Twitter, a TikTok, or whatever. We're on every single platform there is.
Slide in the DMs, it's fine.
Yeah, we'll listen to you. And I hope to hear from you all soon.
Thank you so much, beautiful humans.